Hello everyone, this is Dr. Tao's Quant Lab. In this video, we cover section 1.4, how prices move and when trading matters. This is one of the most critical conceptual sections in chapter 1. Before we look at any charts or indicators, we must understand the mechanics of price discovery. Many retail traders have a mental model of price movement that is technically incorrect, and this leads to poor decision making. Let's start with a very common misconception. You will often hear commentators say money is flowing into the market or money is flowing out of the stock. I want to be very clear. This is not how price move. Every transaction requires both a buyer and a seller. If someone buys 100 shares, someone else must sell 100 shares. Therefore, in aggregate, the total volume of buying always equals the total volume of selling. So, if buying volume equals selling volume, why do price change? Prices change because of imbalance at margin. It is not about the amount of capital. It is about the relative urgency of the participants. Let's define two key terms, liquidity and urgency. Liquidity is the capacity of the market to absorb orders without price displacement. It is represented by the limit orders waiting in the order book. The passive buyers and sellers. Urgency comes from the aggressive traders, those who are using market orders who want to trade now. Here is the mechanism of the move. Prices physically move only when a market participant is sufficiently urgent to cross the speed. When the buyers are more aggressive, they consume all the limit sell orders at the current price. Once that liquidity is exhausted, the price must tick up to find the next seller. Conversely, when sellers are urgent, they hit the bids, consuming liquidity and forcing the price lower. So, price movement is a function of urgency versus liquidity. In a deep liquid market, heavy volume might not move price at all. In a thin, illiquid market, a small order can cause a significant gap. Now, speaking of gaps and volatility, we need to discuss circuit breakers. Sometimes urgency overwhelms liquidity so completely that the market becomes chaotic. To prevent this, ex exchanges use limit up, limit down, or LULD bands. If a stock moves too sharply, typically more than 5 to 10% within 5 minutes, trading is effectively frozen. This is a 5-minute cooling off period. If you see a stock suddenly stop trading during the day, do not panic. It is likely a structural pause, not a technical failure. Now, that we know how prices move, let's discuss when they move. Volatility is not random. It is clustered around specific time and events. We call this catalysts. The most important scheduled time for the US markets are 8:30 a.m. Eastern time. It's the major economic data like CPI and job reports. And 2 p.m. uh, ET, the Federal Reserve FOMC statement come out. I want to highlight a specific phenomenon here regarding the 8:30 a.m. data. You will often see the stock market open at 9 a.m. at a price significantly different from where it closed the day before. We call this is a gap. Why does this happen? It happens because the news, the 8:30 data, was priced in before the stock market opened, primarily through the futures market and pre-market trading. The same logic applies to individual stocks. If a company releases an earning report overnight, it will likely open at a completely different price in next morning. The gap is simply the market adjusting to information, whether macro data or earnings, that was released while the main exchange was closed. This phenomenon of gapping leads us to the broader structure of the trading day. Well, we often say the market opens at 9:30. Electronic trading actually allows for a much longer day. As you can see in this table, we have four distinct sessions. Pre-market from 4 a.m. to 9:30 a.m. This is where the 8:30 data is priced in. Liquidity here is thin and spreads are wide. Regular hours from 9:30 to 4 p.m. This is the primary session where the vast majority of volume and institutional trading occurs. Then after hours from 4 p.m. to 8 p.m., this session is driven primarily by corporate earnings, which are typically released right after 4 p.m. And then last overnight from 8 p.m. to 4 a.m. on the next day. I want to give a specific warning here. While this slot exists, it does not occur on the main exchanges like NYSE or Nasdaq. It happens on fragmented ECNs. Liquidity is extremely low, spreads are wide, and execution is risky. For the purpose of this course, we treat overnight trading as non-standard and generally avoid it. Now, let's zoom in on the most important session, regular trading hours, and break down how price behavior changes throughout the day. We can divide the trading day into 5 distinct fundamental windows. First, opening volatility from 9:30 a.m. to 10 a.m. This is the period of highest noise. The market is reconciling overnight news and the 8:30 data we just discussed. Prices often reverse quickly. For most traders, especially beginners, this is a dangerous window. It is often a trap characteristic by false breakouts and stop hunting. Second, the morning trade from 10 a.m. to 11:30 a.m. Around 10 a.m., secondary economic data is often released. By this time, the opening chaos has settled, and the institutions begin to establish positions. If a strong trend is going to form for the day, you will often see the directional bias establish itself right here. High conviction moves in this window often persist until lunch. Third, the midway law from 11:30 a.m. to 1:30 p.m. During lunch hours in New York, institutional participation drops, liquidity thins out, and prices often drift sideways or become choppy. This is a mean reverting environment. Trade falling strategies often fail here because there is no substantive volume to push the price. Fourth, the institutional window from 1:30 p.m. to 3:30 p.m. This is where the real work is done. Portfolio managers, algorithms, and institutions execute their largest flows. Also, remember that the Federal Reserve releases policy statements at 2 p.m. during FOMC days. If the morning trade is going to continue, or if it is going to fail and reverse, you will see the confirmation here. Fifth, the last one, the close from 3:30 p.m. to 4 p.m. Volume surges as intraday positions are squared for the day and market on close orders are proceed. I want to give you a specific piece of practical guidelines here, what I call the golden window from 1:30 to 4 p.m. If you are an active trader, the period from 3:40 p.m. to 4 p.m. is mathematically very significant. Why? Because by this time, the daily candlestick has largely taken its final shape. The uncertainty of how will the day end is mostly resolved. This reduces technical noise and provides high probability signals for swing entrants. One quick detail on the calendar. The US market operates about 252 trading days a year. On specific days like Christmas Eve or the day after Thanksgiving, we have early closes at 1 p.m. Volume is usually non-existent on those days, so it is often better to stay away. All right, that concludes section 1.4. We now understand that prices move due to urgency consuming liquidity. And we know that the time of day dictates the quality of that liquidity. In the next video, we will move to section 1.5, where we discuss the psychology of investing and the internal discipline required to survive in this environment.